Hello everyone, this is Philipp Jonas for Kalamazoo Valley Community College, and today we're going to talk about Open Economy Macroeconomics Basic Concepts. Up until now in this course, we've assumed that our economy is closed, an economy that doesn't interact with the rest of the world. But that's of course not true. The United States is a very open economy that is integrated into the world economy. There are two major features of this that we're going to discuss today. One of them is already familiar to you. Imports and exports, the flows of goods and services. So a brief reminder here. An export is a product that's produced domestically and sold abroad. An import, produced abroad and sold domestically. And they enter our national income accounting identity as a net figure. Exports minus imports, which of course means that out of the four major terms in our national income accounting identity, consumption, investment, government purchases, and net exports, it's the only one that can be a negative number. In fact, at this point in time, net exports is a negative number for the United States. Let's start out by having a look at the data here. The United States has experienced greater imports than exports for a few decades now. But you will not hear this referred to as net exports in most descriptions in the popular media. Instead, the term trade surplus and trade deficit is more popular. Trade deficit, the current position of the United States, is when imports are greater than exports. So that will be negative net exports in our accounting identity, while trade surplus refers to exports being greater than imports. There's also the idea of balanced trade, a country having imports that are equal to exports. Most often this term is used when we refer to an economy rebalancing, which refers to an economy that currently has a large trade surplus or deficit moving closer to balanced trade. So in the case of the United States, you can see here imports and exports plotted as a percentage of US GDP. That takes away the effect of inflation, since we've got prices both in the numerator and denominator, and also the effect of the US having grown over these decades. Even correcting for these two factors, you can see that the US economy has become more open over the last 70 years. Imports and exports have both grown as a share of GDP. In addition to that, since roughly the early 80s, imports have grown faster than exports, leading to a gap in between those two numbers. When imports exceed exports, that's what we refer to as a trade deficit, which at the conclusion of this data series you can see is at about 3% of US GDP. But product flows, imports and exports, aren't the only feature of an open economy. We also have to learn about capital flows, which you might be far less familiar with. Similar to net exports, capital flows are often described in net terms in macroeconomics. Net capital outflow. This refers to how many foreign assets US residents are purchasing minus how many domestic assets foreign residents are purchasing. Now, since we talk about this less often, let's start out with some examples. Let's say you as a US resident buy an apartment in London. This would not be referred to as an import or export, since that apartment is an asset that's not about to be boxed up and shipped to the United States. But you do take ownership of it. That would make this you a domestic resident buying a foreign asset. Or if we look at US net capital outflow, it would increase US net capital outflow by the purchase price of that apartment. You can think of this as you, a US resident, providing capital to the United Kingdom. we'll get back to that a little bit more when we look at the math of this situation. Vice versa. Should a British resident buy an apartment in New York City, there would be a foreign resident buying a domestic asset, so such a purchase would reduce US net capital outflow. Net capital outflow, like net exports, is a technical term that you'll rarely hear referred to in the media. More often, we'll use the more business-minded terms foreign direct investment and foreign portfolio investment. But now we have to be a little bit more careful. When we look at product flows, positive net exports and a trade surplus, negative net exports and a trade deficit map very closely to each other. On the other hand, net capital outflow, just like net exports, has a direction. It can be positive or negative. Foreign direct investment and foreign portfolio investment don't refer to the direction. You would have to say, for example, that we've got a US resident engaging in foreign direct investment in the United Kingdom if you bought that apartment in London. Instead, the distinction between direct and portfolio investment is about the control of that asset. Foreign direct investment refers to a situation where the foreign resident has direct operational control of the asset. For example, if McDonald's opens a franchise in Moscow, they decide how it's run. Or if you have that apartment in London, you decide if the shades are open or closed and who gets to sleep there. Foreign portfolio investment is also a capital flow, but without the direct control. If, for example, you bought some shares in Toyota Motor Corporation, a Japanese company, you would now be a part owner, sure, but your stake would be so small that you'd have no effective control over how Toyota is run. Instead, you'd be buying this as a component of your portfolio for diversification purposes. That's the distinction between foreign direct investment and foreign portfolio investment. Now, the reason we're talking about capital flows at this point is that they are closely linked to product flows between countries. In fact, let me start out by showing you a central equality in this chapter. For any given country, its net capital outflow is the same number as its net exports. That's not very intuitive, so let me walk you through some examples here. What I'm trying to explain to you here is that if a country like the United States, for example, has negative net exports, that means necessarily it also has negative net capital outflow. If it imports more than it exports, that's the negative net exports, that means foreign residents are buying more US assets than US residents are buying foreign assets. Let's go through two examples here. Let's start with one that moves the two numbers in the positive direction by the same amount. So let's, for example, say that a foreigner buys a US good. For example, a French resident buys a US-made combine harvester. This transaction makes US net exports increase by the purchase price of that harvester. But what's the impact on net capital outflow? Well, in the process of this transaction, the French resident who's paying in euros is transferring those euros to the United States. That means US residents now own euros, a foreign asset, a foreign currency, equal in value to that harvester. Net exports increase by the same amount as the net capital outflow of the United States. This happens regardless if the French resident pays directly using those euros to the seller of the harvester. Even if there's a currency transaction involved, if the French resident first buys American dollars to buy the harvester, they are still selling their euros in exchange for those dollars. So we have the American seller of those dollars now in possession of the euros. That might not be the same entity as the one selling the harvester, but this is macroeconomics. We're keeping accounts at the country level. And either way, the US now owns a foreign asset exactly equal in value to the export it engaged in. Let's run this example one more time using an import. So here, US net exports are going to fall, imports are subtracted, and simultaneously net capital outflow will fall by the same amount, since domestic assets being owned by foreigners are subtracted in net capital outflow. So we've got a US citizen buying a foreign good this time around. Step number 1. US is engaging in an import that makes net exports fall. Step number 2. In exchange for that product, the US resident was paying American dollars to a foreign entity. That American asset is now in foreign hands and therefore makes US net capital outflow fall by the same amount as net exports did. This equality is also central to international economics. Now, armed with this perspective, we're going to revisit saving and investment based on our national income accounting identity, similar to how we did in our lecture on saving, investment, and the financial system. The big difference is that last time when we engaged in this math, we assumed the US was a closed economy, so the net exports term didn't appear. This time around, we're going to track its location. Step number 1. We're going to subtract consumption and government spending from both sides of this identity, giving us GDP minus consumption minus government spending equals domestic investment plus net exports of our country. Now the term on the left here, GDP minus consumption minus government spending, will hopefully be familiar to you from our lecture on saving, investment, and the financial system. That term is the national saving of a country, abbreviated using a capital S. Last time around, when we did this math, we learned that for a closed economy, national saving is equal to domestic investment. But of course, now we're tracking an open economy, and we see that national saving and domestic investment need not be equal anymore. They can be different if net exports is a positive or negative number. So let's use the United States as an example here. We've already learned that the United States has negative net exports, a trade deficit. That means in the United States, national saving, S, must be a number that's smaller than domestic investment, I. And what we learned on the last slide helps to explain how. Substitute the term net exports with net capital outflow. Those two are always equal to one another. And we get a little bit more clarity on this relationship. If a country has, for example, national saving greater than domestic investment, if S is greater than I, where does all the extra saving go? It's not invested inside the country. Well, it flows to other countries as a positive net capital outflow. This is why countries where domestic saving exceeds investment are also referred to as surplus countries. Countries where national saving is greater than domestic investment will run a trade surplus. They might also be referred to as creditor countries, because they are supplying loanable funds to the rest of the world. Option number 2, if a country has national saving less than domestic investment, it follows that net capital outflow must be a negative term. So countries where national saving is less than domestic investment have foreign residents buying more domestic assets than their domestic residents are buying foreign assets. That's why such countries are referred to as deficit countries, because they will also be running a trade deficit. Or as debtor countries, because they are relying on foreign loanable funds to finance their domestic investment. This simple equation, just 3 terms, national saving, domestic investment, and then either net exports or net capital outflow, depending on your preferred perspective, is highly informative for the international position that countries hold at one point in time. Let's return to the time frame we were looking at when it came to US imports and exports. This time around, we're still looking at percent of GDP, but I've now summarized imports and exports as that country's net exports or net capital outflow, which is of course the same number. So orient yourself a little bit here. The US had roughly balanced trade until the early 80s and has been running trade deficits ever since. We can get a better perspective on this phenomenon now that we've learned about the connection between national saving and domestic investment of a country and net capital outflows / net exports. If we look at national saving and domestic investment in the United States, those two figures closely track each other until the early 80s, leading to a balanced trade position. Since then, national saving in the US has been significantly smaller than domestic investment. This has led to the United States becoming a deficit country, running trade deficits or negative net capital outflow ever since. Now, that's a very interesting development, and you will hear many people have an opinion on the US trade deficit. For us, let's focus on it from a financial standpoint. So, over these decades of running a trade deficit, foreign entities have bought more US assets than US residents have bought foreign assets. Here is the net position of this as of the end of 2019. Foreigners owned about $39 trillion worth of US assets, while Americans owned about $28 trillion of foreign assets. This gap, the US net indebtedness to the rest of the world, you can think of it as the sum of US trade deficits over the last few decades. Now, let me be really clear what I mean here by US net indebtedness to other countries. We're not talking about the US government debt. This is total macroeconomic debt. So we are referring to how many more private and public assets foreigners hold of the US than vice versa. Or in other words, when we look at international capital flows, this net indebtedness can both represent a public debt, like for example, the Chinese central bank owning a US government bond, but also a private debt, like for example, a British bank financing an American mortgage. So what about this number, $10.9 trillion? That's a pretty big number. In fact, it's a really big number. It's bigger than any other country's net indebtedness to the rest of the world. So it might be accurate to say the US is the world's biggest debtor nation. Quite a headline too. But at the same time, you have to remember, the US is also the world's largest economy. So we have to put the scale a little bit into perspective here. And the US enjoys excellent creditworthiness with the rest of the world. So excellent that there's a very interesting phenomenon at work here. Even though foreigners own more US assets than Americans own foreign assets, from a cash flow perspective, a return perspective, the returns are still positive in the US favor. The US is earning a higher return on its foreign assets than foreigners are earning on those US assets. That's because the US economy is often considered to be a safe harbor in troubled financial times. So foreigners will hold US assets not just for their return, but for the safety that they provide. Nevertheless, it does mean that if interest rates were to rise that the US has to pay on its assets, it could become very expensive very fast. Now, this concludes the first part of our lecture, where we're talking about international financial and product flows. We need to talk about something else to prepare ourselves for the next lecture: exchange rates. So we've already talked a little bit that if you are buying a product from abroad, or foreigners buying a US product, they might have to first trade the currency of their country for that of the other country they are trading with. The price at which this exchange happens is called the exchange rate of a country, a term you've probably heard before. But this exchange rate, as it's often talked about in the media, is a nominal concept. Recall that from our last lecture. Nominal numbers are those that are expressed in units of money. Today we're also going to learn about its real equivalent. But first, let's run some examples of nominal exchange rates by you. And when you encounter an exchange rate in real life, you have to be a little bit careful. If you are trading, for example, dollars for Japanese yen, you can express that price in two different ways. How many yen do you get for $1? Or how many dollars do you get for 1 yen? So in order to make things a little bit easier for us, we're going to express all of our exchange rates as units of foreign currency per 1 unit of domestic currency. Assuming for a second that the US dollar is our domestic currency, here are some exchange rates from October 1st, 2019. On that day, the exchange rate with the Canadian dollar was 1.32. So this means 1 American dollar was equal in value to 1.32 Canadian dollars. So 1 American dollar was worth more than 1 Canadian dollar. If you had 20 US dollars in your possession and you exchanged them, how many Canadian dollars would you receive? 20 times 1.32. If you had 20 Canadian dollars and wanted to exchange them into US currency, you would have to take the 20 Canadian dollars and divide them by 1.32. Here are some other exchange rates from that same day to give you a bit of a flavor for how this works. On that same day, the exchange rate with the euro was 0.91. So 1 American dollar gets you 91 euro cents. That made $1 less valuable than 1 euro. So the euro and the Canadian dollar, they are pretty close in value to the American dollar. Other currencies have values that are quite different, and that by itself doesn't tell you much yet. For example, the Japanese yen tends to be over 100 times less valuable per unit than American dollars. Again, that's not necessarily a bad thing. It's basically that country using a different yardstick when expressing prices. Or for example, our neighbors to the south, the American peso, again, has a much more different exchange rate than the Canadian dollar or the euro. Now, in real life, exchange rates can be expressed in two different ways, not always as foreign currency per domestic currency. So we don't like to talk about these numbers increasing or decreasing. That could be confusing. Instead, we prefer to use the terms appreciation and depreciation. A currency is said to appreciate if it gains value, depreciate if it loses value. For example, if that exchange rate with the Canadian dollar was 1.32, but let's say that number goes up to 1.5. Now $1 US is getting you 1.5 Canadian dollars. That would mean that the US dollar has gained value, appreciated, and the Canadian dollar had lost value, depreciated. These are the nominal terms for exchange rates. As is often the case in economics, real numbers can be much more revealing. Real numbers, of course, refer to numbers that are measured in physical units, not monetary units. So in the context of an exchange rate, it refers to the following. How expensive is a product in one country versus another once you've adjusted for the exchange rate? Or in other words, how many products do you have to trade in order to get the foreign product? You may have experienced yourself if you've ever been in a country with a different currency. After adjusting for the exchange rate, some prices were higher or lower than in the US when you were in the foreign country. Summarizing this difference is done using the real exchange rate in macroeconomics. Let's start out with a formula which at first can look a little intimidating, but then we'll work through two examples that I think will clarify how this works. So the real exchange rate is expressed as E times P over P star. First of all, what's with the star here? Well, in international economics, we're often dealing with the same variable in both the domestic country and the foreign country. We put a star next to the variable name in order to represent the variable in the foreign country. So what we're looking at in this formula is the domestic price of a product being represented by P, the price of the same product abroad in the foreign currency using P star. And E, that's our symbol for the nominal exchange rate that we've just learned about. E times P over P star. Let me run you through an example. Let's say we're talking about the price of a Big Mac, which, interestingly, is tracked by economists around the world, because it's a product that's very uniform and available in many countries. Let's say this Big Mac has a price of $2.50 in the United States, but 400 yen in Japan. At the same time, let's say the nominal exchange rate between these countries is 120 yen per US dollar. The formula of the real exchange rate lets us determine where, once adjusted for the exchange rate, this Big Mac is more expensive. So let's start with the numerator of the formula, E times P. What that does is convert the price of the US Big Mac into foreign currency. So a US Big Mac at $2.50 with a nominal exchange rate of 120, multiply those two numbers together, you would have to pay 300 yen to buy the US Big Mac. But let's compare that with the Japanese Big Mac. 400 yen. You can already tell the Japanese Big Mac is more expensive. Let's continue the calculation though. E times P divided by P star. So we're taking the price of the US Big Mac in yen and dividing it by the price of the Japanese Big Mac in yen. 300 divided by 400. This is of course a relative price once more. And the relative price of those two products is 0.75. You only have to pay 0.75 Japanese Big Macs to get one US Big Mac. That makes the US Big Mac relatively cheaper, the Japanese Big Mac relatively more expensive. And since this number, 0.75, is expressed in Big Macs, physical units, it's a real number. This will prepare us to understand, in our next lecture, how trade flows run between countries. If Big Macs were a product that were put into containers and shipped around the world, ask yourself, how would you take advantage of this situation? Well, you could make a profit by buying the Big Mac in the US, where it's relatively cheaper, and selling it in Japan, where it's relatively more expensive. All right, let's do one more example here where you have a chance to do the math. Another product that's tracked by economists around the world is a tall Starbucks latte. Again, uniform and available in tons of countries. So let's say we're comparing a Starbucks latte between the US and Mexico. Here are the relevant numbers. The nominal exchange rate is 10 pesos per US dollar. The price of the latte in the US is $3, while the price of that same latte in Mexico is 24 pesos. Go ahead and use this information to first calculate the price of the US latte in pesos, and then to work out the real exchange rate. Go ahead and pause the video now if you would like to give this a shot. All right, let's go ahead and compare our answers. So, first step, we're converting the US latte into a peso price. E times P. $3 latte times 10 pesos per dollar means the US latte has a price of 30 pesos. Step number 2, compute the real exchange rate by dividing that number by the price of the Mexican latte, 24 pesos. 30 divided by 24 leads us to conclude that a US latte costs 1.25 Mexican lattes. And this is called purchasing power parity, or PPP for short. It's the idea that you can use the concept of the real exchange rate to make a prediction about what the nominal exchange rate between two countries should be. Now, this does not work perfectly. It's based on the notion of the law of one price, a very classical economic concept that a product should sell for the same price in all markets. Otherwise, one could buy it where it's cheap, sell it where it's expensive, and in the process of that happening, this process is called arbitrage, the prices should equalize. So what if we applied this across countries? Now, it's not that simple, because in reality, not all products can be traded between countries. And of course, there are matters such as transportation costs and taxes. But it's a great first idea for wrapping your mind around how nominal exchange rates are determined in a market. So purchasing power parity, it's this extreme position. What if exchange rates adjusted until products had the same price in every country? Or expressed even simpler, purchasing power parity is the following proposition. What if the real exchange rate was the number 1? Always the number 1. What's the price of a foreign product relative to the price of the domestic product? 1. They're equal to each other in price. Let's use the Big Mac example one last time. So P denotes the price of the US Big Mac, P star the price of the Japanese Big Mac, E the nominal exchange rate. And this time around, let us go in with the assumption that the prices are equal. So E times P, the price of the American Big Mac, is equal to P star, the price of the Japanese Big Mac. Again, this is the same as saying that the real exchange rate has the value 1, because you could buy the Japanese Big Mac for the same price as the US Big Mac if you had an equal number of yen available. So let's do a numerical example. Since purchasing power parity starts with the assumption that the real exchange rate is 1, all we need is the price of each product, and then we can solve for the nominal exchange rate. The nominal exchange rate should be P star over P. Earlier, we encountered the prices of $2.50 for the American Big Mac, 400 yen for the Japanese Big Mac. Using this information and the assumption of purchasing power parity, let's solve for a nominal exchange rate. This means we are going to divide the foreign price of the Big Mac, 400 yen, by the domestic price of the Big Mac, $2.50. The result is 160 yen per US dollar. This nominal exchange rate would be what the exchange rate should be for purchasing power parity to hold. Again, this isn't true at all points in the real world, but it's a good first guidepost for where an exchange rate might be. And that concludes today's lecture of Open Economy Macroeconomics Basic Concepts.